Welcome, trader. This is Steven with TMT. No pain, all gain. Now let's trade some knowledge. Starting to trade is a big endeavor. Many new traders are eager to place their first trade, but are quick to realize placing a buy or sell order has its own learning curve. Worse, they may learn the hard way, placing a market order and finding their order was filled at a much higher or lower price than intended. Before diving into specific order types, it's important to know that there's a difference between placing an order and an order actually getting filled. Placing an order is you saying to the broker, I want to buy or sell a number of shares of stock. Getting an order filled is when the trade is actually executed by the broker. Just because you place an order does not mean it will be filled. Getting an order filled will depend on your order type, price limitations you set, if any, and the magnitude of shares you're looking to buy or sell. For example, an order to buy 1 share of TMT at any price as soon as possible is more likely to be filled before a buy order of 1 million shares of TMT, only set to be triggered if the stock price drops below a certain price for the current trading day with only 1 hour left until the market closes. There is also another major factor in getting an order filled that is out of your control. That is, the liquidity of the stock. For you to trade a stock, there must be a third party looking to take an opposite position. Quite simply, you can't buy something no one is looking to sell, and you can't sell something no one is looking to buy. This is mostly evident in what's considered over-the-counter penny stocks. But let's assume you find a normal everyday stock of a large company listed on a major exchange. We'll use a fake ticker TMT as the stock you're looking to purchase, with a current market share price of $100. We'll also assume you're looking to buy the stock, although all the order types we'll go over can be applied to selling as well. We'll start with the most common order type, the market order. A market order is an order to buy the stock at the best available price at that moment in time. These orders will typically be filled instantaneously. The price the order is filled at, however, may vary sometimes greatly from the market price at the time you placed the order. On a casual day or slow-moving market, the fill price will likely be filled very close to the market price, usually within plus or minus 1%. On a volatile day or fast-moving market, the fill price may deviate significantly from the market price. This is because of the sheer volume of orders coming in and the orders being weighted towards one side, that is, buying or selling. Pressure like this can send the bid or ask price flying. So instead of being filled around $100, your order may end up being filled around $105. That would be 5% higher than you intended. To prevent this from happening, there's a different order type called a limit order. With this order, you can set a limit as to what price your order can be filled. If you set that limit to $100, for instance, the broker will only fill your order at or below $100. With a limit order, however, you lose your precedence when compared to market orders. Meaning a market order at $100 will be filled before a limit order at $100. By setting a limit, you also risk your order not being executed. If, say, you set a buy limit order at $100 and the best available asking price is $100.01, your order will not be filled. The market price may continue to climb and may never return to the $100 price point, leaving yourself wondering if that extra cent was really worth it. Note, however, you always have the option to increase or decrease your limit price. You can revise the existing order or even place another limit order if so desired. Now, let's say you find $100 to be too expensive based on your research of the company's fundamentals. You determine you would like to invest in TMT, but only if the price falls 20%. This would be an appropriate situation to set a limit order, in this case at $80. When you go to place the order, however, you notice the broker is prompting you to select a duration, that is, how long you want the order to last. You're given 2 options, a day order or a good till canceled order. Selecting a day order would mean the order will remain open for the current trading day only. If the broker is unable to fill the order before the trading day is over, your order will automatically expire. You acknowledge, however, that the odds of the price falling 20% in a single trading day is highly unlikely. So instead, you enter a good till canceled order. A good till canceled order remains on the books until it's either filled by the broker or canceled by the trader. Brokerages usually limit this duration to 90 days, at which time your order will expire if it hasn't already been filled. Now let's say the price does fall 20% and your order is filled at $80 a share. You're now an owner of TMT. Congrats! You're thrilled with your purchase at that valuation. However, part of you is weary about the state of the overall economy and its outlook over the next 3 years. You decide you want to limit your potential losses to 10% in case the economy falters. A 10% drop from your $80 cost basis would set your threshold at $72, where you'd be looking to sell your shares. But you need something that will sell your shares only if the $72 threshold is breached, a trigger of some sorts. Enter another type of order called a stop order. A stop order is a conditional market order. In this case, the condition is the price falling to $72 a share. If the condition is met, the order becomes active and turns into a market sell order in which the broker will attempt to immediately fill at the best possible price. If the condition is not met, the stop order will remain inactive for however long you set the duration, that is, day or good till canceled. Note that stop orders don't have to be sell orders, they can be buy orders as well. For example, let's say you're looking to buy even more shares of TMT. However, you're only looking to add to your current position if the stock shows signs of upwards price momentum. Through technical analysis, you identify a strong resistance level at $85 a share. You determine that if the price were to break past the $85 resistance level and reach $86, that you'd be comfortable purchasing additional shares at that price. To achieve this, you set a buy stop order at $86 a share. In this case, the condition is the price rising to $86. If the condition is met, the order becomes active and turns into a market buy order in which the broker will attempt to immediately fill at the best possible price. Although a majority of stop orders placed by traders are to trigger a market order, you also have the option of triggering a limit order. Using the previous example, let's assume we want the same condition, or stop that is, and we want the price to rise to $86 before triggering a buy order. $86 would be known as your stop price. Now let's say you also expect the price will pull back to $83 after it reaches $86, and you only want to buy shares if your order can be filled at $83 or below. $83 would be known as your limit price. This order as a whole would be called a buy stop limit order. Note the biggest difference for this order type is you have to set two different price thresholds, the stop price and the limit price. Only if the stop price is reached does the limit order get activated. Stop orders can take a while to fully understand. For new traders, it's recommended to replace the word stop with trigger or conditional until the concept is fully grasped. As you can probably tell, order complexity can vary quite a bit. But if we break the order down into categories and take it one step at a time, placing an order becomes a simple process. Are you looking to buy or sell? How many shares? Which stop? What's your price limit, or do you just want to buy or sell at the best available market price? Is there a trigger price that must be met before the order is placed? And how long do you want this order to be open? Mastering these types of orders should be enough to get you through a majority of your trades. There are even more complex order types, but we'll set our stop here for now. Although there are times when placing a market order is appropriate, it usually indicates that the trade wasn't calculated or planned. Put a limit on your market orders and bring your limit orders to the market. Back your orders with analysis, research, and conviction, and let nothing stop you on your path to becoming the modern trader.